So thank you for coming. This is Noshi from Trade Genie. Just a brief introduction. I've been trading full-time stocks and options and futures for last 12 years. Before 12 years, I was trading part-time while working as a SAP consultant from one project to another. And then in March of 2010, I quit working as a consultant and I became a full-time trader. And since then, I've been trading stocks and options, and I provide my services, my trade alerts, and my coaching to my members. I love trading, that's my passion, and I love teaching. So I was busy for a while, so I haven't taught for a few months here and there. I want to um, become consistent. So I have a 1 year coaching program. I have an 8 day coaching program, and some I just teach for as a complimentary because I love teaching. And I do send you the quizzes. So I've developed tons of quizzes on various topics to improve your trading knowledge. So keep an eye on your inbox. Each email contains the content for that topic, and then there is a quiz. So if you want to learn, uh, there are thousands of topics on trading. There's never-ending process. So So keep an eye on the inbox for those emails, read the content, and then there is a short quiz of 20, 25 questions, sometimes 10, multiple choice, true and false, and see how many you got right and understand. So gradually you will improve if you are passionate about improving your knowledge. Uh, what I found that when in trading is very complex. So you know that everybody know trading is very complex, but then things become easier. So it becomes so easy mm, that I wonder that how come it's right there on the chart. So it's like A to Z puzzle. So if you're new to trading, just start putting the pieces, the puzzles together, and then it will become very easy. So it's like uh, it's normal. It's a normal routine. So I do a lot of prepare. So I do a lot of preparation before um, the before, like tonight I'm getting ready for tomorrow. In the morning I get ready in the morning before the market opens, and during the market hours then I'm dedicated to trading. I've done a lot of automation. In the beginning I was doing so everything is manual. Now a lot of things are automated to help me out. A lot of trade alerts, a lot of notifications, and a lot of things I do to help me out so that I can take uh, many trades, not just one or two. So I can divide my risk, spread my risk on various trades. I can maximize my gains. I can minimize my losses. I can capitalize on the winning trades. So I don't want to miss out on the movers. So I cannot, or nobody can monitor 15,000 or 9,000 or 19,000 stocks. So there has to be some process. So I'm a big believer in systems development, system process. I worked as a IT consultant. I worked as a system analyst, system designer, so I know about the processes. So I build the processes. I'm still building the processes. I'm still building the systems, connecting the dots together. So if you have the knowledge of systems or the IT or know someone, take help and progress. So today's topic is a big topic, is about price and volume relationship. So in the price and volume, what the traders do is they just focus on price and they miss out the volume. So price action is important, but the volume also very important. So without taking the volume into consideration, the picture is not complete in trading. So picture is not complete if you don't take volume into consideration and identifying the anomaly or validation between price and volume. And there are certain kind of reactions uh, the stock exhibit on the chart. So um, reading the tape, reading the tape, understanding um, where this stock is headed, whether the sentiment has changed, whether there is an anomaly in this action, or the volume is confirming the is confirming us validating. So these are the topic. I'll go into detail. Maybe it will be like 1.5 hours session. So volume relevancy, price volume analysis, downtrend cycle. I'll give you example of a downtrend cycle and what I mean by inside and outside, uptrend cycle, and then inside and outside. So what is revealed in a candle? So if you're a candle person, only bar, so it doesn't matter if it's a candle or bar. So I use both. I use line chart also in my analysis. So I use candle, I use bar, and I use line charts, all three. So there is an advantage to using all three, mainly candle. So candles tells a lot of stories. So candle, if you look at the candle, is just telling you the price, but then what is hidden behind that candle? So tells you it. You would find out if you dissect that candle in terms of volume and time. So it's like uh, when I was maybe in eighth grade, they zoology or whatever, they asked go to the well, get some frog, and we're going to dissect the frog. So it's like that. You put that frog on the table and then you dissect it. I hated after that, but I love dissecting the candle. So you need to learn to dissect the candle. So it's like a frog. Whether it's art or science, is you decide. There are some perfections and there are some consistency. So we'll talk about that. And but there are some validation or there are some anomalies. So anomalies or validation. And then the concept of a spread. So we know the spread, the difference between the open and the close, or difference between the bid and ask. So this is a spread. But then there are wide spread and then there is a narrow spread. So if there is a wide spread, then the spread is telling us the price. But then what else happened in that spread? When there was a wide spread, what happened in terms of volume? And when there was a narrow spread, then what happened in terms of volume? So understanding the spread, price, and then taking into consideration the volume tells us something more. So we're just trying to take help from the volume besides the price. So the trading is not complete if you ignore volume. So we get trapped. And traders also get excited with the volume. Volume is spike. They watch the volume on a 1 minute chart or 3 minute chart, and then they just get trapped. So that's also not advisable to go for the volume spike. So uh, and when the volume is spiking, then you need to know where the price is. When the price is reaching the extreme, so that could be the climax. So what is the relevancy of volume? So again, why stop at price analysis? So if you're just doing the price analysis, reading the candle or reading some, looking at the pure chart showing the price, it may not be enough. Asking yourself, is volume still relevant today? So yes, the answer is yes, the volume is still relevant like it was yesterday. And then you need to ask, is the volume relevant to the market I trade? So volume is relevant to all the market. Maybe there are some exceptions, I don't know. So you let me know. Volume is relevant. Is the volume relevant to all types of trading, such as scalping, day trading, swing, long term? So the answer is yes, the volume is applicable to all types of trading. Can it be applied to all investing strategies? So whatever is your strategy, focus also on the volume. If you don't want to be alone over there, applying one strategy which you think is powerful, but you're the only person. Unless you have an edge and um, you just came to know, and you're the only one who knows about that strategy. And then there's something called power of wick. So upper and lower wick. So I'll explain. If you don't know what is wick, I'll explain what is wick. It's just a basic concept, but then you need to understand what the wick tells us the story, the upper and the lower wick, and where it's happening in the landscape on the daily chart or on the weekly chart or whatever time frame. So pay attention to the wick because wick tells us the support and resistance. So if it's an upper wick, it's a resistance. If it's a lower wick, it's a support. Then so support and resistance are getting created whole day. Look at any chart time frame and you will see a support and resistance there. But the lower the time frame, the less significant is the support and resistance. The higher the time frame, the more meaningful it is. So if a upper wick or lower wick is formed on a 5 minute chart, is less relevant compared to if it's formed on a day chart or weekly or monthly. So and then combine it with the volume. So what happened at the time of the wick was formed, whether it was upper wick or lower wick. So what was happening to the volume? So we study some of those. Price volume analysis is universal, so it can be applied to all. It doesn't matter if you're trading stocks, options, forex, futures. The volume analysis, price along with the volume is universal. Analysis of price along with volume is supreme way of trading. So this is this sentence, analysis of price along with volume is supreme way of trading. And notice I put the supreme in a capital letters. So this is my belief, and this is the belief of many other thousands of millions of traders who are successful. And there could be there are other millions of traders who don't believe in this statement. So it is your belief, it is my belief. So you trade, we trade our belief. So whatever is our belief, we trade those, our belief. So if we believe that the price along with the volume is supreme way of trading, so we will do whatever we can in our power to understand the volume. Because if we have the belief and we don't implement our belief, if we don't follow our belief, then we are creating conflict and we won't be successful unless you prove that the belief you had was not right. So there are a lot of beliefs in trading or anything in life. They are useless beliefs. They don't serve any purpose. So once you recognize, you need to get rid of those beliefs. Once you find out that your belief is not correct, you need to correct your belief. Then you work on implementing the correct belief. There could be a lot of hurdles, a lot of obstacles, a lot of challenges in implementing that belief. The belief is new and you just find it hard to implement. So do whatever you can in your power, seek help to implement that belief. So for instance, if you are not using volume and you realize that, okay, I missed the volume for so long, I need to implement the volume in my trading. How do I do that? There is a solution. So it's not, everything is done, especially if something is hard. After we do the certain thing very hard, at the end when we complete, it becomes easy. And then the second time, then the third time, so it's the same thing. So create your beliefs, useful beliefs, and then implement, and you will be successful in trading. Another belief is volume create a strong support and resistance. So if we have that belief that the volume create a strong support and resistance, then we need to pay attention to this belief. High volume at the top of the trend and high volume at the bottom of the trend. So if we recognize that this is the top of the trend, if we recognize that this is the bottom of the trend, and there is a high volume there. So if there's a high volume at the top of the trend or high volume at the bottom of the trend, there could be this could be the climax of the trend. So This is what happened when the stock gets overbought and reaches a certain level at the overbought level. That's where magically the volume accelerates. A lot of smart traders they are getting out, and a lot of retail traders, those who are new to trading, they're getting trapped. They misread the volume, they misread the overbought, oversold level. So this happened, uh, buy something at the top. The moment we buy, I say, oh, the volume was so high, it was accelerating. How come I entered in the trade and then it just reversed and that was the top. I got in at the top. How come I bought at the bottom? That was the bottom, and I bought the puts at the bottom. All right, I got out at the bottom. So this is what happened. You're not the only one. The psychology. So when everybody is getting the people getting out at the bottom, there's some psychological levels. You're not the only one who have that feeling that I'm trapped. There are millions of traders. They are trapped at the same price. So when the stock is falling, the millions of traders, they're thinking the same way as you are thinking. So they all participate in the same manner. So volume accelerate and getting out at the bottom, where the bottom is. And then the smart guys, they recognize it. They know where the support is. So they know the support, they know where the fair price is, and they absorb the retail traders volume. And then the stock stops going down and then it reverses. So recognizing the support or resistance level, recognizing where the turn could happen, recognizing that the bottom is approaching is important. Same way recognizing the top is approaching, and this volume is, I need to, if I have a position, then I need to exit from the position, or I need to take some like half or three-fourth or majority of my position out, not getting in. Because if you see the chart, if you see the chart, so when you're entering it, look at the daily chart and see the turning point. Where was the bottom recent made? So that's where the majority of the traders, the big boys, they bought it. So think about it, 10, 15, 20 points before they bought, and you're entering at the top. So recognizing the top of the trend, recognizing the high volume, recognizing the bottom of the trend, recognizing the high volume is important. So support, resistance, high volume, top of the trend, overbought level, oversold level, and believing that volume is supreme. Combining volume with price is supreme way of trading. So create some belief and follow along. Now, the volume. So one can ask question: is volume relevant for all time frame? So I listed the time frame which I use, and there is a reason for these time frame: 13 minutes, 65 minute, 130 minute, 195 minute, day, week, month. So if you look at the, if you calculate the time, the minutes in the day, there are 390 minutes. Week composed of five five days. So week is composed of 5 days. Day is composed of 390 minutes. If you dissect it, if you divide, if you're putting the bar for consistent flow, maybe you want to just call the day as a 390-minute chart. So if you divide, if you want to see the two bars, equal bars, then ideally it should be 195 minutes. If you want to go further down, then it's 130 minutes. If you go further down, it's a 65 minute. And then the bottom level is a 13 minute. So people put 10 minute, 15 minute, maybe you want to put 13-minute bars to have equal bars, 65 minute. So 65 minutes is five 13-minute bars. 130 minute is two 65-minute bars. 195 minutes is 365-minute bar, and day is two 195-minute bars. So equal bars. So the 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 flow is smooth. So the volume can be applied to any of the time frame. So when the trading, when I'm looking at the at any symbol, let's say I'm running my system, I'm um, sorting it. So let's say I'm sorting it based on some actions, price, volume, and there's something coming on top. For instance, let's say Baidu is coming or Snow is coming or whatever is coming on the top. So I immediately plug in that. So I'm looking at the day chart. So this is the day chart I'm looking at. So on the day chart, the volume bar is there. I can see, but it's not complete because the day just started. So if the day started, the volume bar is there, but it's not. I cannot tell right now what will happen to the volume because the day just started 15, 20, 30 minutes ago. I know that I need to put my symbol on an intraday level. So intraday level, I have other workspace. So various workspaces, you need to have various workspaces. So when I look at the day chart, I put my symbol there, and then I lean on the weekly chart. I must see the weekly chart. I must remind myself, hey, Noshi, don't forget the weekly chart. See the support and resistance. And if the weekly chart is not giving me some ideas for swing trading, I don't need to go on a monthly chart. It's too far. But if I can read proper support resistance, then I take a look on the monthly chart also. So this is the one time frame I have, day, week, and month, and I'm looking at the volume on a day, and I can see uh, just by looking at the price, I can see there is some reaction. So you can see the rhythm. It's like a horse moving back home in my language called tuck tuck, like tuck tuck tuck. It's some kind of a rhythm going on, and you can see there is some price action. So you put on the day chart, analyze the whole landscape, analyze the landscape, see that okay, yeah, this is where uh, either the sentiment is changing. I'm a chart pattern trader, candlestick trader. I combine breakout, gap, some contraction, some consolidation breakout, some reversal. So there are various kinds of technique. So when I look at the day chart, I analyze immediately that this is what's happening. This gap, let's say the stock is gapping up. So if the stock is gapping up, how far it has gapped from the previous close. If it has gapped too much, then I ignore that. If the gap is meaningful and it's not extreme, then I take a look. So day chart, this is a one workspace. Then I need to put my symbol on intraday workspace. So intraday workspace is this workspace, 13 minutes, 65, 130, 195. So, and then there is another one, 5 minutes. So 5 minutes, I cannot divide 13. So it's like 5 minutes. 5 minute is my bottom chart. So there are two intraday level, and I need to um, smoothly, there is a transition. So the transition needs to happen. So 5 minute, 13 minutes, 65 minutes. 5 minute is not mentioned here. So 5 minute, 13 minutes, 65 minutes. Then another workspace is 65 minute, 130 minute, and 195 minute. So if I'm looking at 5, 13, and 65, then I know what was happening in 65. Then I have another workspace where 65, 130, and 195. Then I have another workspace with 195 day, week, and month. So I can see the uh, previous bar. So analyzing the volume on these bars is also very, very important, including the 5 minute. So the volume needs to be there along with the price. And there must be some kind of a smooth move. If there is a 5 minute chart and the stock is moving, if it's really moving, it should be moving like a stair steps. So think about you know we go on a mountain or we go some temple somewhere. Let's say you're climbing up the mountain, maybe in Cambodia or Thailand, and they have stairs. So and then they have a landing space, and then you rest, and then you climb up. So that's the way the symbol should be moving, and the volume should be consistent. So volume is important in all time frame. And then another thing I do is the analysis of the relative volume. So previously I used to do manually, now I do it automatic, develop the programs. So So the relative volume, the time segment of the volume. So volume needs to be segmented based on the time and its previous history. So I'll give you the example on a day chart, on a daily basis, if the stock moves, let's say 1 million trades at 1 million shares on average, let's say based on a 30-day average. So based on a 30-day average, if the stock moves, trades 1 million shares a day. So, and I know that one day means 390 minutes. So if I divide that volume by 390 minutes, 1 million shares, I get certain number. So I get that certain number, and I know per minute the volume should be this. Then I so if only 13 minutes have passed, then I take that 1 minute volume multiply by 13. So I know that on any given day, on average, on a 13-minute pass, the volume should be this number. But when I compare the volume in the 13-minute pass, or let's say 15-minute pass, or 30-minute pass, I see a certain number of volume. So I take the difference. I take the difference and I take the percentage. So my system does all that. Previously, I used to calculate manually. So my system does that, and I come to know that the volume is quite high compared to 1 million volume on average for last 30 days. Um, on average, a 15 minute, it should be, let's say, 200,000 shares, and is already trading at 400,000 shares. So it means the volume is double and only 15-minute pass. So that is one indication that the volume is double, 200%. So I get that alert that, on my monitor, that this volume is high. So different. Then I give the rating for that volume. I'm giving the rating, high, unusual volume, or above average, average, etc. So all those kind of ratings are coming to me, and I'm paying attention. So at different time interval, as the time is moving forward, the volume, relative volume should be the same, or at least around the same level. So if the volume was very high during the 13-minute, like 500% or 1,000% of the average, but when I look at the 65-minute later or 26-minute, the volume subsides. So there was a volume spike, and now it's coming to the, it's dying. So that trend is not a valid trend. So there is an anomaly happening at the later time frame. So all this goes on during the day, and for all of my open position. So if I have open position, I'm watching this volume and deciding whether to stay in the trade. So let's say I have a trade open, and I have three targets. I call green, yellow, and red. So if the yellow target is hitting, and I'm thinking, okay, the yellow target hit, I'm up 50% in my option, and I need to take profit. But then at the same time, the alert comes that the volume is high, it's 300%. So now I need to pay attention um, from this angle, from this point of view, why the volume is high, whether this volume is occurring at the overbought level, the move is extreme. If the move is extreme, then I would probably ignore the volume and say, okay, this is the time I really need to take. But if the move is not extreme and the overbought level has not reached, I'm up 50%, the volume is high, there's a news, the overall the market is moving. So I would hold on to not selling that or exiting from that trade. So volume and time frame is valid. Volume is valid for all time frames. Volume is valid for all types of trading, whether you're doing scalping, whether day trading, swing trading, long-term trading, pay attention to the volume. So again, I explain that volume is relative. So the volume in the first 13-minute, 15-minute, high volume may be good for that 15-minute. Maybe if I was a day trader or a scalper, and the volume is high and I want to get in and get out is valid. But for me as a swing trader, maybe during the first 15 minutes, the volume was not valid. So all volume is relative. Volume is a powerful indicator. So this is a belief that the volume is a powerful indicator. Price without volume is meaningless. This is another belief. And time is the key component. So this is another belief that time is the key component. So dissecting the candles, uh, dissecting the candle. So there is a volume. Let's say there's a volume of 1 million shares. So then where most of the transactions happen, at what price level? So this you won't know on a day chart. You need to look at the intraday level and plot the volume bar on the time frame and the price. Then you would know that the most of the volume occurred in this price range. So if the stock, let's say, moved from 100 to 103, and most of the volume was, let's say, at 101 and 101.80. So that is um, and if the stock closed at 103, then 101 to 101.80, that's the strong support. That's where the most of the action happened. That's where all the buyers are. So time is the key component. And at what time of the day um, that transaction happened. So during what time of the day and during what price level. If you look at the day chart, it won't give you any of such information. But if you dissect it, then you would know that this is the price level, and during this time of the day, um, most of the volume occurred. So if you can combine the time component, then on a relative volume, then it's become even more powerful. So let's say if you have the data that during the 1.5 hour, when the 1 hour pass, this is the usually the volume for this stock. So if you're reading the volume and comparing the time also, not only the average based on 390 minutes, but also taking into consideration the time of the day, then your relative volume figures become more accurate. I don't go into that detail, but if you can do that, it's even more that during this time period, the usually this stock trades at 400,000 shares during this 1 hour, but now it's trading at 800,000. So if that is happening, that may also help you. So you combine the time into the price analysis. So here is if you have seen I just want to explain to you the one candle, the bullish candle and the bearish candle, just in case you don't know the candle. So just in case there is someone uh, among you don't know what the candle is and what is the wick is. So I'm just trying explaining, and then we move forward. So here's a candle. It looks like it's a white color. So usually the white color candle, you can name any, and you can color the candle in whatever shape, whatever color you want. In China, they color the bullish candle in with the red. So if you're looking at the chart in China, all the stock which are going up, they are in red color. So you can color your candle. So this is just a color of white color. It looks like it's a bullish candle. So the open is here and the close is here. This is the wick. So it tells us the high of the day, and this is the low of the day. So lower wick, higher wick, and the spread is the spread between the open price and the close price. So since it's a white candle, so I say, okay, on my chart, I color the uh, bullish candle as a white color. So I'm giving the meaning. So I give the meaning, we give the meaning. So you can give any meaning you want. Let's say I give the meaning that for bullish candle, where the price close is higher than the open, I will name it white color. So I named it that white color candle is a bullish candle. So if I know the white color candle is a bullish candle, then I know this is the open, this is the high, this is the close, this is the high, and this is the low. So this is the spread. So this is the spread. But if we're looking at only this candle, and there's no volume here. We are not doing the justice to our trading because we are not um, analyzing the volume. The volume should be there. So this price candle, if you if you if this is a sine wave, so the market moves like this. So open, low of the session, then it goes high, and then it close. So the spread is positive. So open was here, the close was there. So the stock during the bullish move, they do like this. So this is the move. They go in a sine wave. So low of the session here, high of the session here. This is the close, this is the open, and the spread is positive. So this is the sine wave. So here is the downtrend cycle. So inside and outside. So I'll explain inside and outside. I have already like little bit I have told you, but I'm explaining more. So this is the open. The market starts to move down. So selling pressure is building, 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 and then the big at the bottom. So this is somewhere the low of the um, trade happened, somewhere there. And then, so there was a selling pressure, and then the sellers um, got exhausted, and the buyers came in. For some reason, they find this price as a valid price. They find this price as a fair price, whatever is the reason, but it's their belief. So they start buying it, and the buying pressure builds up, and then the close happen at the same price as open. So the spread at the open and close is the same. There's no spread between the open and the close. So there's no spread between the open and the close. So open and close, the spread is zero. So just by analyzing, just by looking at this chart, it doesn't tell us much story. We don't know where the volume bar was high. So we need to look at the intraday level chart and understand whether the volume bars were higher on this side of the price action compared to the volume bars at this side of the price action. So, and not only that, but then if you look at the time frame, then dissect the time. What time of the day the most of the price action happened, where most of the volume happened, and at what price level. So where, at what price level most of the volume occurred, and during what time of the day. By looking at this, just simple as this chart, the open was here, low form, and then the close, you do not get clear picture. So if the volume build up right at the bottom, so this right at the bottom, and the volume start to build up here, then the buyers, we tend to believe that the buyers were constantly buying. There was a constant buying pressure going on compared to the selling pressure. Or there was a certain price level where the volume bars was high, and then it died down. And maybe the volume bars was right at the climax. There was, and then nobody was left to sell. And then gradually the buyers came in, and the volume bars start to pick up, and the price when closed at the same price where the open was. So the net change was zero. So this, when this happens, you may notice the net change is zero. The stock falls 10 point down, and then during later in the day, the stock close at net change zero. So that is a bullish sentiment. So the kind of candle you may see may be the hammer candle. So hammer candle form, the volume on an intraday chart level where we dissect where the low was. So figure it out the low, and then go on an intraday chart, see at what time frame the low happened, and then analyze the volume bar and see. You may come to know the what in terms of volume what happened, whether the volume was higher on this side or the higher on the left side. So if you're not convinced, so if you're aggressive trader and you recognize this phenomena is happening, you may initiate a trade. So this could happen. This is an intraday reversal. So this could happen if it's a day chart. This could happen during the day, and intraday reversal is happening, and you may initiate once you recognize that the volume is happening, and um, there was a let's say on this left side when the stock is falling, there was some hesitancy in falling. It just stopped at a certain price level, and it spent some time, and then it broke down. So it broke down. So the volume was high at certain price level at this in the middle of the selling pressure. So that price range becomes the resistance on the way up. So so when this, if you dissect this side of the chart, the selling pressure side, and then when you are watching the intraday reversal, so you may be hesitant in initiating a long trade, but once this congestion zone, by looking at the intraday chart and looking at the volume, you analyze that okay, this is where the volume was, and this was the price range, and it's breaking to the upside. You may want to initiate a trade. Um, think because you're an aggressive trader, and your stop would be below some low of the day, below some low of the day. If you are conservative, then you would wait for the next day. So next day will tell you where um, which way this camel is going to sit. So sometimes the hammer is formed, and then the stock takes few days to. It has bottom. Actually, it has bottom here, but it's taking few days to make its mind, and then it starts to move up. So if you're not sure, then you wait for a few more days and then take the trade. If the gap up occurs after the intraday reversal and the next day the gap up occurs, that's your clear cut signal to go long. So I tend to take the trade when the intraday reversal has occurred, and I put that stock on the watch list. And if the gap occurs, then I take that trade, because I know now that this was resistance was taken out, this low is formed, intraday reversal happened, and now the gap is occurring. So this is a confirmation for me. And then I apply all the intraday level volume analysis. So what is revealed in this chart? This chart is, if we dissect in terms of time and volume, we come to know that there may be a complete reversal in market sentiment. So this is very powerful trading when you can detect the change in the market sentiment, whether the whole market or whether that individual stock. When the complete reversal is happening in that market, and you can detect the sentiment has changed, the suddenly the stock which was getting clobbered suddenly reverse. I give you example of Caterpillar on Friday. So Caterpillar came to my attention at around 218, and so it gapped up. If you look at the Caterpillar chart, it gapped up. The volume, so I did the volume analysis, just like I described to you, and 219 was some resistance, but then I based on the when the resistance is approaching, when there is some resistance there, and you see that, but the volume is very high, just below that, and you can read the volume correctly, then what you're doing is you're anticipating that the resistance will be broken. So you're kind of stepping ahead of the move, that this resistance, you're betting that this resistance will be broken. So let's say I see the Caterpillar at 218, and 219 is the resistance. So I I started watching it on a 5-minute chart, and based on I just couldn't wait for 219 to break. So I knew, like, gut feeling, your sixth sense, that this will break. I mean, very low chance that the 219 will not be broken. So at around 218, 30, 40 went into the Caterpillar, and by end of day is 228. So the sentiment in Caterpillar has completely changed on Friday. So it's a very strong. The move on Friday could be the like a temporary extreme move because um, the caterpillar gapped up from. So we need to see when analyzing the stock, we need to see where the close was. Not only the move from open to close, but from the previous close to today's close. So from previous close to today's close, not just open to close. So so the close was around 209, 210 on Thursday, and today on Friday it closed around 228. So imagine it closed on Thursday around 209, and then it closed on Friday 228. So 19-point move. So out of 19-point move, we caught like 9.5 point because the gap. So the gap, if you are unless you went long on Thursday, then you caught that gap also. So this is an extreme move on any given day. So what could happen on Caterpillar? On Monday, it could pull back maybe towards 225, find its support, and then it starts to move up again from 228 to 230, 235, something like that. So I'm still holding Caterpillar. So complete market sentiment change in Caterpillar. Selling pressure overwhelmed by buying pressure. Sentiment on the close of the bar is bullish. So this these slides are prepared long time ago, 1 year or so. So I'm just giving you examples. Just remember it's Caterpillar. So sentiment on the close of the bar is bullish. So when the stock closed near the high of the day, so the statistics is that 80% of those stocks um, next day move higher. So what are your chances that the Caterpillar will go down on Monday compared to go up? So the chances are that the Caterpillar on Monday will go higher than lower because it closed near the um, it closed at the high of the day, near the high of the day. So just little bit pullback is not um, meaningful. So if not on Monday, maybe on Tuesday and Wednesday. So it's prudent to hold Caterpillar for more bullish move. But if you're going long on Monday, then you're going at the extreme. So it's not good. So the picture is not complete without volume. So volume is missing. Lower wick. So pay attention to the lower wick. So pay attention to the lower wick here and what happened afterwards. What was the volume just before the lower wick was formed? The spread was zero in this chart, the chart I showed. Volume inside of the candle unknown, volume outside of the candle unknown. So if you don't plot the volume, then you don't know what it means by outside. So outside of the candle means if you're looking at the day chart and looking at the volume bar, let's say you pull out the volume. So you can see 2 million shares or 5 million shares, but you don't know unless you go inside the candle. So it's like dissecting the frog. So you need to dissect, you put the frog on the table, take the knife, cut the belly, open it up, or like a chicken, you put the chicken. Sometimes I see the guy, butcher guy, when I go and buy the whole chicken and I ask him to cut it, so he cuts it in small. Then he asks me how many pieces. Then I tell him the pieces, then he cuts the chicken. Same way, you need to cut the candle into pieces. So the pieces are 13 minute, 26 minute, 65 minute, etc. And then you put the time, and then you say, okay, during this time interval, at this time of the day, during this price level, the volume was high. So that tells you about the support and resistance. So that is inside of the candle. Outside of the candle is you're just plotting the volume bar on a day chart, and then you're just seeing the volume bars. So volume histogram. So that is inside and outside. So picture and relationship, big picture, volume and price relationship. So when you plot the volume bar on a day chart or any chart, if that time frame is a big picture. But if you want to go into detail, then you switch your charts on a lower time frame. Go into a lower time frame. lower than your entry time frame. So if your entry was based on a day chart, by looking at the whole landscape, then your lower level charts are 195, 65, 13, etc. So here's another example of uptrend cycle and inside and outside. So here is the open of the trade, and there was a buying pressure. So the stock just kept going, 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 going. Sometimes it happened. The stock just keeps going, and then we say, okay, yeah, we are in profit. I'll sell tomorrow, and then go and do something. Go and drive 2 hours to meet your friend, and then when you reach, um, coffee shop, and you tell your friend, "Hey, friend, did you see that?" And then he said, "What?" It closed at the same price that open. And then you open your app and you said, "Damn, what happened here?" Yeah, so it went from 100 to 120, and then it closed at 100. So the net change is zero. So the spread was zero. So when the spread was zero, what happened? Some news came, and the sellers came and they just started selling, or the news which was driving this stock, that news was not a good news. So that was a bad news. So initially the traders reacted, and then something happened, and then the traders reacted, and the stock closed at the low of the near the open of the day. So this high, then we need to so there's a big form, and then we need to dissect. So this is a bearish move. When the stock does that, this becomes indeed a bearish move, and the sentiment has changed. So this is not a good sign. So what the stock will do next day will tell the real story. So this is still like at the borderline. The stock next day should move up, should trade at in this time zone, in this price zone, where from the high and the close, in between this price level. If it's start to break down, then this is complete reversal. So this is no good. So next day it will tell you the real story. The stock should move up. So by looking at this chart, it doesn't tell us whether the volume was high at the buying side or the high on the selling side. So we need to dissect this symbol on an intraday level and the time frame. So this is what um, the way uh, the candle looks like. This is the hammer, this chart. So this chart, um, yeah, this chart looks like this hammer, or you can say another name called dragonfly. So the open was here, the low was made here, and the close was at the top. So when this happened, this is extreme bullish uh, chart. This is extreme bullish chart. Selling pressure was here, buying pressure is here, but still we need to analyze the volume on both sides to figure it out where actually the most of the price action happened, where the volume was, where the most of the volume was, at what price zone most of the volume occurred, and in what time of the day, and where the volume on the buying side occurred and what time of the day. So knowing this tells us the support price and support, but this is indeed a bullish move. So if you are aggressive trader, when you recognize this phenomena is happening, the earlier you take the trade, the higher the return, because your trade is getting away from your stop. Because your stop, this is where the traders make mistake. If they're trading options, let's say they're trading options, and then they set you know they set the stop at 40% or 50%. So technically the stock has told you that this is my low, so only get out when I violate this low. So I don't care if you're trading options, I don't care if you're trading a weekly chart or a weekly option, or just expiring 2 days later. I don't care. My I don't care about you trading option, whether weekly, monthly, quarterly, leap, whatever. I don't care if you said 25% stop spread stop, or you bought at the higher spread, etc. This is my stop. So the stop needs to be based on the stop. So as long as if you are an aggressive trader, when this phenomena is happening and you recognize the volume, it is very prudent and the reward is high if you initiate some trade, initiate a little position when this phenomena is occurring, because your stop is still the same. And then the next day when the stock gaps up, so a lot of the stock after creating this kind of phenomena, they do gap up. So that is your second entry, the gap up. Or if you did not initiate the gap above, the next day is your entry, but your stop is still stays at this level, because even after the stock gaps up, it may come down and trade in this zone, in this buying zone. The stock may trade still in the buying zone and then find the support and moves up. Usually the support could happen somewhere in the middle of this bar, between the low and the high, somewhere in the middle, because remember there was some price point here where most of the selling occurred, and the buying was going on and selling was occurring, and then the final breakdown. So this zone is was the resistance, which turned into the support zone right here. So when this resistance, when on the way up, when this resistance was broken, this created a support right here in the middle somewhere. So I don't have that. I'm not drawing. There's no price. There's no line here. I'm just giving you the concept. So I hope you can visualize it. There was a selling here. So the stock doesn't just fall. Some stock they just keep falling like a waterfall decline, but most of the stock they are going down step by step. So when the stock is selling down, there's some buyers think this is the price. I need to buy, so they buy, and then the sellers overtake, and then it starts to crash, and those buyers they also get out, and then more sellers come in, and then this phenomena keeps happening where when till all the sellers are gone, and then the support happens. So support is formed and then the stock starts to move up. So when the stock is moving up, there are some traders who are still on the sideline. They are not buying into this reversal because they just don't believe in it. So if they don't believe in it and the buyers are less, then the sellers, um, the traders here, this is the resistance, because those who miss selling at this price, when the stock reaches on the reversal, they tend to sell. So when they tend to sell, the stock does the temporary move down, and then the buyers overtake. So this zone, which was a selling zone, supply area, becomes the demand area. So even when the stock gaps up, so when the stock gaps up, the all the traders who are left behind, they have a regret. Now so regret is one of the very serious kind of emotions. Regret is a very serious emotion. So those who are regretting, they say when this stock comes down to this price, because they dissected it, they know now that this is where most of the price action happened, this is the support, so I'm going to buy it. So even when the stock gaps up, it can pull back, and if you put your stop somewhere in the middle here based on the option, the stock doesn't care about your option trading. If the stock pulls back here and your option is sold, and then it reverses and then it goes up. So in other words, when you spot this reversal and you can read the volume, get in, put the stop here. This is your aggressive. You don't need to buy everything. Next day, when the stock gaps up, you add more to the position, or if you're not in it, initiate your position. Expect that stock could come, just the stock could do its thing. It can just fly away, or it can pull back. If it's pull back somewhere in this zone, figure it out the zone where the stock is supposed to uh, rest. If it comes down and rest and then reverse, then this is your another buy point, and your stop is here. So if you're trading option and you're putting some wild stop in the middle here based on your criteria, so the criteria is I just want to lose $500. If I hit 500, I'm out. So okay, the stock doesn't care your dollar amount. I'm out when I hit the 40% stop in my option. So stock doesn't care. You can maybe you have the technique to enter If you hit your stop of 40% and you have the technique to re-enter, then re-enter. So re-entry is another powerful technique. Even you get out for at loss, then you should have a way of getting back in. So if you can do that, then it's good. Now this is this one uptrend. So this one is this chart, and it's called, in the Japanese they call it gravestone. So it's like a gravestone, and a lot of buyers are graves are buried in this price action because the open was here and it made a high. There was a lot of buying pressure, and the stock made all the way to the highest top of the mountain, and then some bad news came, whether it's related to this particular stock or overall market. Something, some tweet, some news, somewhere some bomb fell off, and the stock just came and closed at the open. So when the net change is negative, and one time it was way high, then you need to dissect the volume and say, okay, where was the volume, most of the volume, whether it's the buying side or the selling side, and at what price level and at what time of the day. So do this analysis, and so if you look at this, if you are already in the if you are in the trade, and let's say you initiated the trade somewhere here, so at the end of the day you are a loser, so your position is showing loss, but not to worry too much. If you had a position before and the stock gapped up, I mean moved up, and you did not take the profit and it pulled back. Sometimes the pullback is slow, so slow, and then by the time you realize, by the time when the market close, it does this. So it happens. So it's still not. You need to worry due to the sentiment change. So your next step would be the stock needs to open up somewhere in this zone, in this selling zone, and this is where the resistance is. So the resistance again would be somewhere in the middle. So figure it out where the volume, most of the volume occurred and what price zone. So do the analysis on the buying side, do the analysis on the selling side. That is your resistance. So this is your resistance. So when the stock is trading in this zone, as long as it's trading above the close, you may be fine. And when it crosses the resistance, you know by dissecting the candle, um, you know the resistance level. When the stock crosses this resistance level, that's where if you're not in the trade, that is where your entry comes. If you are already in the trade, then that's where your adding to the existing position comes. So there is some resistance level in this whole uh, high to open and high level. There is some resistance level. So figure it out, this resistance level, and when the resistance breaks, either you initiate a new position or you add to your existing position. So if you were in the trade before, somewhere here, and this is what you saw, the profit. Now you're not seeing that much profit. So you're not seeing that much profit. So this is your resistance, ultimate resistance, and actual resistance is somewhere here in the middle. So when the resistance is broken, instead of uh, exiting from the trade, you might want to add more to the trade, because now you know the sentiment had changed during this day, but now the resistance is being broken. I want to add. Whenever the sentiment is changing and it's you getting some confirmation, you need to add more to the position. So if you have 5 contracts, maybe you add 1 or 2. You will be adding at the higher price, but you're adding it to the higher price because based on what the stock is telling you. You don't worry about your previous position you had. You may want to add to the next month. So if you're holding a July option, you may want to add August option. If you're holding a 30 strike, July 30, and it's already in the money, you may want to add July 35 or July 30 or August 30, 35, August 32.50 or July 35, something you're adding more because the sentiment had changed and now the stock is reversing, is breaking the resistance, is going up. So you want to add more to your position. So I do that. So this is where the money is made when you can recognize the winner and you add to the winner position instead of exiting right away. So the money, the fortune is made in one of the few big, one of the out of 10 position you have, the money is made in one or two positions, not in all positions. Some position, $400, some with $300, some $200, but one of the position is telling you, okay, this is the position I need to pay attention. This is the stock I need to pay attention. So is the volume analysis an art or science? So price and volume analysis is an art. You can apply the formulas, etc., automate it to get some alert and the some help, but it's an art. Volume analysis is subjective. So what I'm reading, the volume, you may be reading it differently. Market does mopping. So mopping is, when the stock is falling down, the selling pressure is building up. So all the sellers are being absorbed by the buyers, and then the market does the reversal. So this is called mopping. When this mopping process is occurring, you need to be patient. So be patient, keep watch the lower level time frame, such as 5 minute, 13 minute. So market shakes off weak hand. So remind yourself that weak hand can be shaken off. When volume is detected, be patient. So when the volume is building up, be patient and see whether when the volume is building up, whether the support is also, if the market is moving up and the volume is there, whether the support is also building up. So this, the way the support can be recognized is the stock pulls back and then it moves up. Then it pulls back a little bit, then it moves up. So it's clearly evident on your 5 minute chart or a lower level chart. So when you remind yourself that I need to be patient, then patient, this is a mental state. So being patient is one of the mental state. So there are many mental state. One of the state is be patient, be very strategic. So when you remind yourself that I need to be patient, so when you're patient, then the patient mental state triggers the process of stocking the trade. So different mental state triggers a different process. So stock the trade. So remind yourself that I need to be patient. I need to adopt the process of stocking. So the way, so how do you stock a trade? So pull out um, that process and stock that trade. Read the tape, read the price action, read the volume, draw the support and resistance line. So drawing the support and resistance line is a channel. So it's like a canal. So draw the upper line, draw the lower line, get some alert, see the alert, and the alert tells you that the stock has broken the resistance, the stock has broken the support. Then draw another line, widen the support and resistance line, and now the stock is trading in that support and resistance zone. So leave that stock alone. It's trading, it's doing its thing. When another alert comes, then take a look and take some action. Evaluate the landscape. So evaluate the landscape. Look at the 65-minute chart, look at the 195-minute chart, day chart, evaluate the whole landscape and figure it out. Is the rain stopping or more showers to come? So mopping process is ending or the mopping process is still going on. So now there are some perfections also. Sometimes the stock does this. So this is kind of perfection. Um, so V-shape, V-shape rally. So really rally, V-shape rally. I'm getting tired now. 608. So the open was here and the V shape occurred. So open and close. So this can happen. V shape rally can occur, but they are rare. They are dark pools. So in the dark pools, they're invisible orders. The big boys, they go and hide their orders in the dark pool, and the retail traders, they are not aware of. So you can detect some activity through level 2. They're high frequency trading. So the high frequency, they run your order. So I don't, being a swing trader, unless I'm a scalper or a day trader, I am not worried too much about the high frequency trading that I will lose 2 cents here or 5 cents here. It's okay. I'm not worried about 2 cents or 3 cents or 1 cent. I'm worried about my entry and I'm more worried about my exits. So I'm looking at the bigger picture. So for me, high frequency trading and level 2 market depth, etc., does not matter too much. Now, what I'm worried about the data imperfection. So what I'm looking at the low or what I'm looking at the high, is it correct? Sometimes the prints are wrong. So if you see the wick, upper wick and lower wick, um, we must have more than one source for data confirmation. So must have um, more than one trading platform, more than one chart to verify. So if you have a doubt that this I'm seeing this price action, is it really valid? Sometimes it's not. So confirm from other sources immediately. So there could be a data discrepancy, there could be data imperfection. So there could be and due to fake bits, you see some wick on the upper side or lower side. So all this kind of games are being played. The cancel orders, they place the order and they cancel it. So all that thing is going on. The speed of your infrastructure. So if you're a day trader or a scalper and you are trading a high frequency, then maybe you're worried about your infrastructure. But I do worry about my infrastructure. In my infrastructure is I have 3 computers, 14 monitors, internet, high speed, laptop, etc. And Starbucks close to home. So which Starbucks is close to home? Which Pete Coffee? Where I can go if, let's say, my internet dies. Do I have mouse in reserve in case my daughter used to chew my mouse? So I used to buy 5 mouse. Now my children, they are 5 and above, so I don't need to worry about my mouse. So my infrastructure, I have proper equipment, proper internet connection, etc. So if you're a high frequency day trader, maybe you want to move to close to the exchange. So they do that. They have done it, but I'm not there, and I don't want to be there. So data complexity and consistency. Data feeds are complex, so data must be reliable and consistent. So when you are in doubt, open have more than one trading access to one trading platform and check the high, the low, the open and close, the upper wick, the lower wick. You need to make sure that you have proper data. What you are seeing, you're making your decision is correct. Volume is relative. So remind yourself, volume is relative. What volume you're seeing, the time frame may be valid for the particular kind of a trader and not valid for you. Maybe it's valid for the scalper when he sees the volume is spiked 500% on a 1 minute chart, and then they send you the alert saying buy this. We see the volume, and then when you look at the volume, you say what, like 15 minutes ago on a 1 minute chart. So that is not relative for you. So don't get excited. That kind of a volume is not good. So you need to judge your volume from one bar to another bar and remind yourself what kind of a trader. Traders, they get confused. They are swing trader and they are looking at the volume on a 1 minute chart or a 5 minute chart. Unless you are exiting, unless you are entering in that trade and you have done your homework, the bigger homework, you're not worried about that 1 minute volume or a 3 minute volume. You don't do that. You judge your volume from one bar to another and have a complete picture. Pay attention to the relative volume. Pay attention to what time of the day is there. Segment the time and volume. I explained to you the relative volume. So I segment the time and volume, relative volume, and pay attention whether the relative volume is building up or stable, or is just it was a spike in the morning and now everything is dies down and there is no relative volume is not high. Now another thing you need to pay attention is the validation or anomaly. So price is validated. So if there is a move in the price, is the volume coming in? So if the volume is not there, that price is not valid. So um, be concerned about that. So be aware. Anomaly occurring. So it could be an anomaly. So I'll show you via chart what is how the validation looks like and how the anomaly looks like. So be aware of that there could be an anomaly occurring, and how you determine the validation and anomaly when you remind yourself that I need to watch the whole full landscape. So like you're driving. when you're driving, you're looking at both your mirrors on both sides, your rear view mirror and the side mirrors. So if you're just looking in the front and not looking on the side and the left, and 10 cars behind you, the guy is coming, and you can spot him half a mile behind you, you know that when he comes close to you, uh, the danger is coming. When he's coming close to you, he is in a hurry. He's changing lane, left, right, and then when he passes, so you need to give him the way and expect that he will die. In a few seconds later, he will die. He will take some people down, but you don't want to be part of that process. So let him go, and let him go 2 miles, 5 miles, and you pray that you don't see him. So that's the full landscape observation. So when you are spotting the anomaly, so that driver, you need to be ready for it. Volume and price combination tell the truth. So always keep the volume and the price in front of you and observe it on a full landscape, which is your day chart and the intraday level. So here is the chart. The chart is, so you see, this is a candle. So this is a white candle. So for me, the white candle is, let's say, the bullish candle. So I color my chart and I say, okay, any bullish move, I color it white. So white meaning bullish. So I gave the meaning white as bullish. So if I'm plotting the volume, so this is my average volume line, and any trading below the average line is below average. Any trading going above the average line is above average. So now I look at the candle, and the price, the spread is wide, so between the open and close, and the volume is above average. So this tells me there is a validation. So there is a validation in this price move. Yeah, chicken is better than frog. So I agree with you, John. So this open and this close. So the spread is wide and the volume is also above average. So this price action is telling me that this price move is genuine move. Unless, unless there's always a if and but. So there's an if and but. So if this move, so I don't know this move. I see this candle. I don't know what else happened before. What happened before, I don't know. This is just one candle. So your next question should be, so Noshi, you're showing me only one candle. uh, what happened before this candle? Show me all the like at least 9-month chart. Show me all the turning point. Tell me if this move is a gap or is a continuation. So if it's a continuation, then this is really bullish move, high volume and the gap. Whether it's beginning of a trend, even though if it's a gap, it's a beginning of a move, or it's an exhaustion gap, it's occurring at the overbought level. What else is going on? So there's a lot of things we need to look at. That's why we need to look at the full landscape. But let's assume that this is a bullish move and this is the above average volume. So when there's an above average volume and the wide spread is there, so I have a tendency to believe that this is a bullish move and it's validated by the volume, and more bullish move is expected to come. So more bullish move is expected to come after this price action, and then the whole landscape is being evaluated. So conclusion is the effect is in proportion to the effort. So any of the cause and the effect. So the more effort you do, the more result you get. So that's the direct relationship. So the more result, more more result, more effect. The more effort you do, the more effect you have. So this is this is what happened to Caterpillar when it came at 218. So spotted that, okay, this is a valid gap. Even though it was a gap, it was a valid gap. So gap trading is, you need to pay attention. In the gap trading, you need to pay attention to the volume and all the previous turning point, the support and resistance, etc. So price move is genuine. Price is not manipulated. So price gets manipulated when the stock moves up and then there is no volume. So that's where the price manipulation comes, or the price move, the stock goes down and there's no volume. That's where the price manipulation is happening. But when the stock is moving up and the volume is there, the price is genuine. When the stock is going down and the volume is there, that move is genuine. So anything other than that is being manipulated. So volume is validating the price. Market is bullish. Market is bullish, but be suspicious. So always in trading, you need to be bold and courageous and all that. But on top on besides that, you need to be always suspicious. This what the other guy is thinking, what I am not thinking, or what I'm not looking at. So always think from the other guy's point of view, what the other guy is thinking right now. Am I getting in at 218 and the stock gaps up from 209, already moved 9 points, what the other guy is thinking? So the volume may help you. So look for the anomaly. So always remind yourself that I need to look at the anomaly, and if you don't find any anomaly, then take some action. Now here's another chart. So here's the average volume line, and this is this candle. So this candle is a narrow spread. So this is a narrow spread. Compare. So what is narrow may be wide, and what is wide may be narrow. So it depends also. Then it depends on the average move, the ATR on average. If you're looking at Tesla, and let's say the Tesla on average moves $7, so for Tesla $7 is normal, but for General Electric, $7 is like a huge. So General Electric, 30 cents is normal, 50 cents. So what is so only you know that this candle is a narrow candle or a wide candle. So let's assume this is a narrow candle. So narrow spread on the candle body, and the volume is low also. So when the volume is below average and the candle is also small, so there is a validation. There's not an anomaly. This is a true picture. So this is a true picture because the volume was low and the candle was small. So if I'm already in the trade, so now if I'm on, if I'm trying to initiate a trade, I won't initiate this trade because I said the volume is low, the candle is small, unless I'm seeing this candle appearing at the strong, very strong support. So I'm anticipating that this is a very strong support. The volume is, although the volume is low, this candle is forming at a very, very strong support. I'm expecting a positive news Sunday night, and then on Monday, this stock will go up. So maybe it's a crude stock. I'm expecting some bullish crude news on Sunday, and on Monday the crude stocks will move up, even though the candle is small, the volume is small, but it has a strong support, so I may get in. But most of the time, I wouldn't initiate the trade. But if I'm in the trade and the candle is doing this, so it depends where this candle is forming. If this candle is forming near the resistance and the volume is low and I'm already in the trade, so I may be exiting with profit, I may be exiting at break even, etc. But I may not be initiating a new trade because this is not a strong move here. The candle is very little. And if this candle is forming at the so now you need to look at the full landscape. So full landscape means you're looking at all the nearby candle. So if this candle is appearing after a big move, or the big move occurred, so let's say this move occurred. So this move occurred. This is a bullish move, average volume high, and that little white candle is appearing right on the top here. So next day, this little candle appears and the volume is low, but since it's a white candle, since it's a bullish candle, the volume is low. So I'm expecting that, okay, I understand the previous day the move was huge. Today there are not many buyers left. So today move is a little, not much volume, but at least it's staying at the top of the range. So after a few days, the stock will move, take another rally leg up. So I'm holding this position. So many things going on besides watching the volume and spread. Now here's a different scenario. The spread is wide, but the volume is below average. So this is an anomaly. So this is an anomaly. So when this happened, if I'm in the trade, I would exit from the trade. If I'm not in the trade, I wouldn't take the trade because this is an anomaly. All right. So this is open, this is closed, the spread is wide, the volume is low. So when the volume is low, if I am not in the trade, I won't initiate the trade. If this is a gap up, if this is a gap up and I'm already in the trade, I would exit from the trade because the gap occurs, there was no volume. So I would exit from the trade. So this is an anomaly. So what is happening? Something is wrong because market makers feeling the sentiment of the market, large spread, higher volume, validation. If the large spread, lower volume is anomaly. So always try to look for the anomaly before initiating the trade. And if you're in the trade and you're seeing the green, whether you need to exit or you need to hold. And then ask yourself, why has this anomaly appeared? So figure it out a reason. If not, so if you don't have any reason to hold and you are already in the trade, then you need to exit. Market is not joining in this price action. So when this is happening, market is not joining in the price action. The market maker just moved up the price. There was no follow through. So if there's no follow through, you need to exit. If you're in the trade, if you're not in the trade, you need to don't initiate a trade. Here's another phenomena. So narrow spread and high volume. So this spread is narrow and the volume is high. So if the volume is high, why the spread is narrow? The spread should be high. And why the spread is narrow? Because there is a distribution going on right at this time. So um, the buyers are there, but the sellers are there. They sell. And then the buyers come in, they want to buy, and then the sellers give them. Then the buyers come in, and then the sellers, they just it's like you are in the swimming pool, and then and you are in the swimming pool, and then there is a gorilla. So you're swimming, and then the gorilla comes and he puts his hand on top of your head, and then he pushes you down. So you try to come up, then he pushes you down. So there is a big gorilla sitting there, and he is pushing you down by putting his hand over your head. So this is what's happening here, the large volume. So there's a lot of buyers and sellers, they are fighting here, and the price is going nowhere. So this is called a spinning top. So this kind of action, most of the action occurs at the top of the trend. So especially if there's a gap up. If the gap up is there and the volume is high and some overbought level is there, you need to exit. So when you spot this trade, you need to exit. So I was in the Baba trade. So I was in the Baba trade, and on the Friday, the stock did something like this. So I exited. I don't know if the Baba will go up, fly, but Baba did not do the same action as Baidu. So although I exited with profit, I saw this kind of action on Baba. So I exited. Where the Baidu action was very different. So Baidu, I sold some and holding some. So keep this phenomena. So price and volume anomaly, potential trap. So there's a trap. Battle by the big boys to hold the market, top of a bullish trend. So it could be a top of the bullish trend when this kind of phenomena happening. The white candle appearing, bullish candle, but the volume is small, but the volume is high. And on the other side, so you need to ask yourself this question. So again, the full landscape. Is this candle appeared after in an uptrend, or this candle is appearing on a downtrend? So if this candle is appearing on an uptrend, if this candle is appearing on uptrend, then there's a distribution going on. But if this candle is appearing on a downtrend, then there is an accumulation going on. So there is a difference between what is happening before. That's why it's so important to observe the full landscape. If this candle is appearing after a downtrend, this is a bullish phenomena because the close is higher and there's a large volume. There was a downtrend there. So what happened? All the sellers, they're trying to sell, but the buyers, the big boys are holding this position. So expect an upward move. So what happened next gives you the confirmation. So ask yourself, what else is there? look from the all angles. So it could be a bottom of a bearish trend if the downtrend was happening. Further effort does not result in higher prices. So what happened? There was a large volume and there was no result. But if there was a downtrend, then expect the market to move up. If it's an uptrend, expect the market to move down. So imagine a car moving up the icy hill road. So if it's an uptrend, and imagine the car moving up the icy hill and it's not going anywhere. In the case of downtrend market, it should have been a large black candle. So if this was a huge um, volume, then this candle on a downtrend should be huge, but it's not. So it means the sellers are getting absorbed by the buyers. Now, the last slide is a single bar versus overall price action. So in other words, one bar does not give you the true picture. You have to analyze the whole landscape. So single bar price action validated with associated volume, overall price action validated by the overall volume. So need to look at the overall volume. The volume in one 5-minute or 10-minute or 13-minute bar could be low, but then you need to look at the whole day and see, analyze the whole picture. What else happened? Maybe at that time, when you're looking at that time frame, it's a lunchtime and there's no price action. So big boys are in the move. You need to pay attention to the overall picture. So this concludes price and volume, exactly 1 hour and 30 minutes. All right. So if you have any question, please send me email or send an email to my team. That's it. I'll see you next week sometime. Thank you. Bye.